Good morning, good afternoon, and good evening, everyone, and welcome to Fundraising Strategy for Venture-Backable Founders. My name is Allison Berardi, and I am a program coordinator for the High Growth Impact Founders at Nasdaq Entrepreneurial Center. For those who may be new to the center, we're a nonprofit dedicated to expanding access to knowledge, networks, and mentorship entrepreneurs need to build and scale companies. Today's session is designed specifically for founders building companies with significant growth ambitions. Whether you're raising capital, managing venture investors, scaling go-to-market, entering new markets, or preparing your company for long-term scale and exit opportunities. Many of you are operating in environments where speed, scale, and capital efficiency matter, and where decisions are shaped by investor expectations and rapid growth. This programming is intentionally built for founders navigating that kind of trajectory. Before we dive in, I'm going to launch a few quick polls. We use this feedback to help guide the programs and resources we build for this global community of entrepreneurs. While you're answering, feel free to drop in the chat where you're joining from today. It's always great to see the range of places that founders are dialing in from. We'll also have a live Q&A at the end of this session, so please feel free to submit questions at any time using the Q&A box. And while the poll is running, I'd like to briefly recognize the partners who make this work possible. The programs we provide at the Nasdaq Center are supported by organizations including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Narrate Foundation, KKR, BPM, and Blend 360. Their support helps us expand access and knowledge for entrepreneurs around the world, and we're so grateful for their partnership. So now let's get started. I want to give a very warm welcome without any further delay. Please help me welcome our special guest, KK Hart, entrepreneur and strategic investor and advisor.
I'm so glad to be here.
Great. So let's get started with our first question. Many founders think fundraising starts with a pitch deck, but investors are evaluating much more than the presentation itself. What signals are investors looking for before a founder ever gets in the room?
I love this question because I think a lot is evolving and the entire venture ecosystem seems to be shifting in ways that have even challenged the way I think about investment. It may be helpful to know a little bit of my thesis and how I think about things. I sit at the intersection of something quite unique. I run a modern family office. It's about 30 million in investable assets. And essentially what I do is a mix of advising and consulting, strategically investing, and acquiring independent businesses. So I kind of do all three. And most times I'm the largest or first institutional, but angel-like check on the cap table. And so what I'm finding more than ever because of that is I'm having much more candid conversations, much more relational interactions with founders than ever before. Part of that I think is a unique strength and skill set, but I think part of it also is because I am the matriarch who made the money, who's investing, and because I'm also the advisor and an acquirer at times, I sit on both sides of the transaction. And I think the first thing I would say that I'm looking for is it's got to go beyond a perfect pitch deck. It's got to go beyond a perfect opportunity. It really has to do with the way the structure of the business aligns with this kind of unknown je ne sais quoi of the founder who's just so passionate about what they're doing that the thought in my head is no one else could do what this person is doing. And so a lot of times when you're supporting a founder like this, whether as an advisor, an investor, an acquirer, you find that that grit gets them through really tough days. And so while I love a balanced approach, I have a very holistic approach to the way that I do everything. I think that mix of structure and passion is really what that first thing is that signals to me, this is someone I've got to speak to. This is someone I've got to connect with. No, I will say it's not enough. I'm a big believer in structure and systems. I'm sure we'll get into that. But I think overall, that first connection, that collaborative vibe, it really has to start with the first conversation so that there really seems to be an area that as investors, we can step up with more than just capital and support the founder and the business to the exit goal that we'll all have.
I love how you mentioned the beginning is everything. So, your work with companies across different stages of growth, how should founders determine whether they are truly ready to raise institutional capital versus continuing to go through revenue and partnerships or alternative funding sources?
Yeah, I'm very passionate about this. I'm actually very clear, even as an investor, that there are many ways to grow. And when I think about the different ways that I've been on both sides of the transaction, I've been on about 300 million in exits. What I often find that's overlooked is the internal ways to grow, which also makes you a better investment capacity. And so I think the thing that is often overlooked is that there are times where I'm founder friendly enough and an advisor, and it goes beyond just telling you to go for that last stage of growth, right? So before institutional capital, we all know that, we're looking for sales, we're looking for traction, we're looking for velocity. But what we're also looking for is an understanding of how the business will grow and evolve over time. I always say shift happens. And so, one of the benefits of focusing on other aspects of growth, besides just that end goal of an exit that we have, is that the business is more permanent. It feels like it can withstand a lot more storms. And I think what ends up happening is a much more robust business. And that's regardless of number of SKUs or types of clients. What I'm often looking at is ways to grow sustainably inside the business without that capital infusion and seeing how well that's managed first and then reaching out for acquisitions and an exit as that external versions of growth. It may help if I break this down a little bit more. There's two ways to grow that I think it's often overlooked. And we're finally starting to see the fractures of that in the venture ecosystem. And I think we're also thinking a little bit more about when we hand over a check, can this business do more than just, run meta ads and grow that way? So one way to grow internally would be to scale the existing business as is and really kind of focus on other KPIs, other key performing indicators of the business. Perhaps that's cash flow, distributions, alternate ways to even structure the way that you would work with institutional capital. That's an internal way of growing that many times is overlooked because it seems like it's harder, but it's actually easier. You already have the client. You already know, what you're expecting to put out into the world. What you're now looking to do is find more people to do that with and really enjoy the growth of the business in a much more holistic way. The second is to add other services and products and offerings, so really expanding your category or the number of things that you do to the same client base. So really getting that share of wallet. If I see a business that meets those two internal areas of growth, it is a no-brainer for me to hand over a check to go for those external areas of growth. So I think what ends up happening is the things that go really well are often brought to the limelight very easily. But I think these are the areas where founders struggle. It's also why I advise so adamantly in this area. But it's also an area that you can prove your success so that when institutional capital comes in, we know exactly your playbook. We know the structure. We know how you're going to get to the exit. And we know how you're going to manage the eventual, ebbs and flows that come with this.
Wow, that's so informative. I think one of the most unique things about you, KK, is that you have this operational experience too. And I know that that informs so much of your work as a venture capitalist. So could you just talk a little bit about that unique combination that you carry?
Yeah, it's interesting because I never thought I would be doing this. So let me start there. I started my career as a behavioral science for very large companies. And what I found as a behaviorist that really, really, I think set me up for great success in the investing world is this understanding of operational efficiency. We did Six Sigma very early on in the 90s and early 2000s and really looked at how a business can grow in a way that is just so much more efficient, but also lends itself to a different path of growth. It's not just hyperscale. It's not just at all costs, but it's really around the idea of being so sustainable that the business can actually weather all storms and be a part of the ecosystem for a very long time. So that's the first kind of carve out of my career. I started advising and then acquiring because I felt so passionate about businesses that were, small businesses and independently owned and operated, and that would never get to that next step if they didn't have those systems in place, and started implementing that with business owners for about a decade before I started acquiring. I ended up acquiring 10 different businesses and really found my foothold on this idea of can businesses be made great or are they just born great? And so I guess this is why I'm so passionate about investing in businesses now is I can tell you that regardless of what stage you're in financially or where you're at with the business or even as a founder personally, all of those things are related. And so I always say business is personal and your personal life is certainly, I think, a business. And so because personal and professional development are so incredibly intertwined, I really have this, people call it founder friendly approach, but very holistic approach to the people inside of the business as well as the systems and the structure. So it's been very full circle to do this now with my family. I invest everything with an investment committee of myself, my husband, my two kids who we adopted out of foster care, and our dog. So it's an interesting way to really be an institutional check to founders who are often looking for something a little bit more human these days and a little bit more connected. But I wouldn't do it for, anything else in the world. This is exactly what I'm supposed to be doing.
Oh, well, thank you. It's very inspiring. I think I'll just take us to a place where if you could identify how you've touched on this a little bit about how you identify when a founder is really ready for investment.
I think the basics and the table stakes everyone knows is that there's certain things that I think especially at this level, we look for in a founder. And if you're not already an exited founder, for instance, I find that there are some things you can do to prove your success, even without having that in your, past. A big part of this, I think, is how we manage stress, how we manage, the difficult aspects of business. I don't shy away from that, as you can see, because I know so much of what's made me successful and every business I've touched successful is being able to navigate the different things that come up. So there's like a level of emotional resilience and structural resilience that a business needs. But ultimately, what I see in a founder who's really ready for venture scale is an identity. It is a person who's willing to go from founder to operator and then really to architect, where they're really systematizing every aspect of their own founder dependency in the business, the team that they lead, the communication that's needed, as well as, of course, whatever skill sets. And so I think what I often see I could put words to a little bit is this idea of a one-way door versus a two-way door. A two-way door is a decision that's completely reversible. Trying a new productivity tool, moving, changing your morning routine. These are things that are considered almost productive, but also can be changed. A one-way door is hard or impossible to reverse. And so when I'm thinking about a founder that may not have that, perfect venture capital 3 times exit on their report card, so to speak, I'm looking at what other aspects of their personality, of their strengths, where their grit is, that can show me their capacity for more. And so when I think about a founder who can manage two-way door decisions versus one-way door decisions, I think what it essentially does is it strips the need for that pedigree, which we're often known for caring about, and now really looking at finding founders who have been through stuff that can make them apply that to their professional lives. So their personal struggles, honestly, their authenticity and autonomy around that allows me to then see, wow, this person has decision velocity. They can decide what is a reversible two-way door and walk through it immediately. They can do what I call a 70% protocol, which is to understand that you only need about 70% of a decision in order to go ahead and take action because you're going to iterate. You're going to find ways to improve beyond that. So that's like a level of emotional resilience that I think a lot of founders either have or don't have, or it can be coached, but it has to be known early enough where, coming on the cap table means we understand where you're at so we can actually support you through that.
So great. Thank you. How can founders effectively communicate both ambition and credibility when they're telling their company story to an investor like yourself?
I mean, I would say not to be trite, but to start with the heart. I think there's something to be said about, I've been asked a lot lately about boring businesses versus heart-led businesses. And actually, I love both, but I do think they're different. There's a ambition that happens when you're thinking about like, what does the market ask for? What are the things that are already fitting into the box that every investor is clamoring into? And then there's leading with heart, which is again, that person that just has such a story about what they want to accomplish with the business they've created. It has nothing to do with a TAM. It has to do with this idea of who is the client that I just can't stop thinking about. Perhaps the founder is that person or that client. And then also, I think being able to have clarity on who they are as a founder beyond the business A lot of times I find that that passion and that vigor for the business can sometimes come off as it's the founder's entire identity. And therefore, then I have to struggle with, well, will they be able to let it go eventually in order to get the exit that we all need as investors in order to be successful together? And so I find that it's a balancing act for sure, but I think about ambition with heart, but also clarity on who you are inside of this business that you've created. I think once you've communicated that, I see you more as an ally to get to the finish line. Um, and I think going beyond gut feeling, there's something to be said for someone who can really talk about their business, regardless of if it's, early revenue or pre-revenue versus revenue generating, that really tells you where they're headed and where their heart is. And I think sometimes those are different things, and being able to reconcile that as a founder is one of the most important key skill sets in order to really go to the next level.
Very, very interesting. So how many touch points do you usually have with people who are looking for your investment before you write the check?
Yeah, I don't have a standard number, but because I do so many different things, I think what I've learned, which would be most helpful to the group, is that this is a highly collaborative, very relationship-based way of going for growth. And so, gosh, I mean, I've seen touch points that go the span of multiple years before a check is, passed over. And then I've seen businesses that I happen to have the ability to experience the business first as a consumer and then realize that there was synergy with the founders and then come on the cap table. And that's been exciting to see. I think the best answer for that is as much as needed to really figure out if there's alignment. And now more than ever, I am getting behind the virtual screen, so to speak, and really getting in front of in-person events and connections. And there's just something for that that I think can be balanced well with in-person being for, let's call that introductions and a start, but virtual being used for depth. And so I find that I'm meeting more frequently. I'm putting my hand up a lot more, and I'm also taking my time while trying to move towards a shared goal with founders. So that often means, more touch points, more times to just get to know each other as human beings, really understand our values, our core belief, our worldview. You'll see I don't sound much like an investor because I'm not talking about money in this moment. I'm talking about how our values align, how our goals can collaborate. And that's really where I've seen the most success. So I find that I'm meeting people more than ever and really trying to spend time getting to know their needs beyond just the check so I can provide more than just capital at the end of the day.
Great. Thank you so much. How can founders approach capital raising without allowing it to become a distraction from really operating their business?
Yeah, this is hard because it is a highly relational process, like we talked about. It's a time intense process. And yet, I think fundraising in and of itself is a full-time job. I think the best way to do this is to think of yourselves, and I'd love to know if you're willing to in the chat, let me know, are you pre-revenue? Are you in growth stage? Like, where are you at with your business? Because I think the answer to this is actually relies on the size of your team, the size of your support, the size of your business. If you have the ability to really give other people aspects of your to-do so you can focus on that fundraising piece, I do find it's often better for the founder. They're not stretched thin. And as an investor, it proves the ability to transfer the business over time. Another thing I always think about is superior time management skills. I was an early adopter to artificial intelligence, but the one thing that that's not taking away is leadership skills, interpersonal communication skills, the ability to really use your time wisely. I think that's actually becoming more important than ever. And I think that's exciting because it allows us to really use our human skills more than we ever thought was needed in a time of great, excellence in technology. And I would say the last is to think about it less as a transaction and more of a conversation. My favorite investment ever has always come from having that warm touch, frequent follow-up. I love being on investor updates, even if I haven't made an investment yet. I really love, oh, this is good. I'm so glad you asked this question. I really love when I can get to know a founder, both relationally and over coffee and all of that. But when I can see in their investor updates that they set a goal, let's say in Q1, And by Q3, they've addressed whether or not that goal has been met. They address what's happened since that goal was created. Did things go well? What went wrong? What's their plan? It really gives me a deep dive into the brain work of the founder and of the business. And it allows me, even when things don't go well, by the way, to really see the people and the processes so I can see myself as a part of the business and how I can support it. I find that more than ever now, I don't think I'm just investing in products and services, I'm investing in people. And so that gives me a chance to really go further faster.
Wow. You can see from the chat, it's very lively, and people are really both growth stage and pre-revenue, both, which is what we had talked about in our preparation for this wonderful fireside chat. So, we really want to get your perspective on how can people really best prepare to have these conversations with you? So, what are the milestones that founders should focus on before they get to interact with you?
I'll say for me, I'm unique because I work with founders at all stages, all industries, all backgrounds. And that means I'm quite unique. I would say working with any help, you really want to understand where your business is at. I talked about the four stages of growth and the four different ways to growth, two of which are internal, two of which are external. I created this system because after the 200 or the 300 million in exits, what I often found was there were founders that would come for one level of growth. They would say, I need investment and I want to go for this big acquisition. But they were overlooking these other areas of success, right? The other areas in which they could grow market share, where they could make more cash flow, where they could actually do things a little differently in the business and get a lot more monetary success. So I think what would be helpful is to break it down with such a diverse group, maybe by, and these are going to be arbitrary a little bit, but maybe by stage of earnings. And so when I think about that launch phase, that 0 to about 500K, you're really trying to figure out product market fit, right? And so I think that milestone should be sold but not oversold. I think a lot of projections and a lot of excitement comes out in this area, but I like repeatable processes. I want to know, what demand have you found? Where are you struggling? Where's the proof of your capability, but also where you're stuck and where you need support. When you get to that next level, let's call it scale, you're maybe over 500K, all the way up to a couple million. I think this is where the target fits differently. It's less about product market fit and it's more about channel market fit. And what I often see is that even when you're earning, right, you're revenue generating, a lot of times what we need to do is look at the business and go, what are the best ways that you're growing revenue? Is it profitable? Should it be? Sometimes it's not. What makes sense for the channels that you're currently in? Should you expand? Should you contract? And I find that, right up to about 5 or 6 million, that seems like work that should wait for the enterprise level. But I find that the founders that really allow me to, roll up my sleeves with them there, they're so much more successful. They have something I call optionality, right? They have the ability to go, do I actually need this venture investment or can I grow my own way for a little while? That makes for a great founder to invest in. It also allows for a founder ecosystem that's, I think, giving a breath to this idea of having other people come into your business before you're ready and before the business can really present the needs and the next steps that are needed. So I would say that's that messy middle that most founders find themselves in. At the enterprise and the high growth level, this is where, we're really thinking about who will acquire you. So having a really good understanding of what does that look like? Are you IPOing? Are you looking at and already courting, conversations with your, potential acquirers? I like that to start really early. I found the best exits are multi-year, non-contractual conversations with your advisors and your acquirers. And so, running a process is one thing, but I think having a process that's very informal and allows you to be collaborative and to find the best fit for your next step. It's less about money. It's more about having that business go on in a way that feels really good. And that can start as early as that messy middle stage. But really where I see it thrive is, you're making about 6 to 10 million and you're really starting to think about where will this go in the future?
That's great. And KK, I'm just curious, how often do you take a board seat when you do these investments? Do you always take a board seat? And it sounds like you also are a very hands-on advisor, almost like an incubator for founders. So just would love to hear you speak about that.
Yeah, I've been really hesitant about board seats actually. Even I would say my most exciting investment that I've made in the last 12 months, I've not yet joined the board, but I've supported the business in many ways, including as an advisor. So I say almost always I come in as a strategic advisor, may negotiate a little bit of additional equity for that. But ultimately, my goal is to support whatever the business needs. And so there'll be a time where I really see a fit for, board activation, but it's not always. I think where I'm best and most helpful and often overlooked is that advisory, almost consulting like position where I'm able to roll up my sleeves and leverage my marketing agency to actually do work for the businesses that we support and we invest in. So that's kind of a unique niche to our Modern Family office is we have this marketing agency inside that we can then use as ammo for the businesses that we invest in. And I find that that's actually much more gratifying because I'm very hands-on, as you can see. And it gives the founders a chance to really breathe and not be Jackson Jills of all trade. It allows them to be honest about where they need that support. Almost always, marketing and go to market is the thing that really, I think, makes or breaks businesses these days. And being able to have that in my back pocket with excellence has been, I think, more rewarding than even having to be on the board. But I'm always open to it. And I always say, that's such an important position in a business. Even after investing, I think multiple years later, sometimes we'll have a side letter put aside for it, but we won't even execute that for a little bit while just to make sure that it's the right fit for the business and for us.
Well, thank you. That's very unique. I would love to get your coaching for our founders just around, if they are in a position to receive a check from someone like you that's very hands-on. Do you have any coaching for them around how to really align with that kind of approach, hands-on approach?
Yeah, well, this is interesting. I think I'll be a bit of a contrarian here, but I think this is the area of malcontent that I've seen more than ever when discussing outside capital. I think founders are really great because they talk to me like a friend and an advisor more than anything, even when I'm an investor. And so what ends up happening, I think, is that there's a misalignment of what is really going to happen after that check gets secured. And what I'd love to hear more about is having that conversation like very directly early on, but also with a structure, like I said, with a side letter, with a scope of work, with really clear specificity on what that looks like, and then also having a time frame, whether it's ongoing or within a finite time. And I think that's often missed. What happens is, and I hear this from founders, I hear it from investors, there's a lot of excitement around being supportive, but not a lot of clarity on what that is. And so that creates a real misalignment. Where I think I'm feeling a lot more hopeful is because this is such a collaborative process, and I think it's getting more collaborative than ever before. I think there's time to have clarity on that. And if we can do so, I think in a very mutual manner, but also in a very consistently open manner, we can get a lot more accomplished. That's where those leadership and interpersonal skills really make a difference. Because, my real talk on this is on both sides. I think it hasn't been done well often. And I'm kind of seen as a maverick in this whole thing. But I
Yeah.
think it's more and more needed because, while I know it's more challenging than ever to secure capital, I also know that the wrong capital is never the right fit, and vice versa. I think the wrong founders for investors that just don't see the vision the way that they want it to go, it's not worth it. It's more painful than it is purposeful. And so when I approach a capital stack and I look at an opportunity like this, I'm really looking at how the founder can kind of navigate their own personal needs alongside the professional needs of the business. And that way, there's real clarity on what's needed. Sometimes all I do is talk to the founder about their own money management, their own, marketing needs, their own things that they are really stuck on but don't have a person for yet. And so I think that level of authenticity and openness, we're starting to get there, but this is why it may be more important to have a few more meetings than you may think, or have more time with investors before and after the check. So there's just a real understanding about what's needed to make this a mutual relationship.
It's very helpful. Do you have any direct coaching for our founders around how to identify alignment with investors? Any exercises that they can do around mission and values that would really safeguard them from, problems down the line?
I'll give two. I mean, one is internal. I rarely meet a founder that says they would turn down a check that wasn't aligned. And it's because a lot of times it doesn't feel like another one will be coming. So I would say that first gut check is really internal. It's almost an integrity test on, what are you really looking for out of this? Where do you want to go? How will you use the money? Yes, but what do you need skill-wise that you're overlooking? I think the skill gap is just such an interesting area that's often overlooked because it seems like money solves all. And it couldn't be more not true. I would say the second is mutual due diligence. I'm a big believer in understanding the person holistically and then the business separately and then the two together. So that may be, as simple as speaking to past founder they work with, which I'm always very open about for that reason. But also, I think getting to know that investors' wants, wishes, what makes them tick. Something I've thought a lot about of recent that I think a lot of investors are, but they're not maybe as open about, is that my investment thesis that has worked for the last 20 years, I don't know that it's going to work for the next 20. So I'm making changes as I go. I'm actually thinking more about investing in layers instead of just industries. Meaning there may be some things, this is fresh hot take here, but there may be something between taking creative businesses and then collaborating with product businesses or taking businesses that really are more media driven and then taking services and intertwining them. And so I'm thinking less in structured, very industry driven, ways of how I invest. And I'm thinking more about where are the collaborations. So even within myself as an investor, I'm thinking very differently about where those checks go next and for the future. So I would say that's something worth thinking about and really getting to know about your investors as well. I would caution anyone to think that because you invested in one thing as an investor, that you can't make it known, or as a founder, you can't ask, are you thinking about anything else? Are you going outside of the box a little bit? So you can understand, is this worth your time? Should you follow up? What does it look like in the future, right? Maybe the cadence is that every year or so you just pop in and see if they can get together for a few minutes and see where they're at. Those are some of my best investments that I've made, is when my changes actually reflected changes in a business that could work out very well.
Great. I'm curious about when you lead a round or a raise, what gets you in that leadership position? Where, you've covered a lot of this, but I just wondered, is there anything our founders should be thinking about in order to create that opportunity with a lead investor?
Yeah, well, there's a couple things that I think always make me tick, and I think most investors would say the same. When I look at the KPIs, the key performing indicators of the business, customer acquisition cost has kept a lot of us up at night. And so those are like things I think about that may not be very sexy and exciting, but they're the reasons that I move forward faster, or that I'm even willing to entertain something that may be considered off thesis. We're typically a later stage investor. So what we do, because we earned all the money instead of raising capital, is that we think very clearly about monetization as that first touch point, but we really generally invest near profitability. And so oftentimes I think what ends up happening is that we get excited about what could be without realizing what is. And so customer acquisition cost of recent has been very challenging to overcome for a lot of really great businesses. And so I'm thinking about that very importantly now. I'm thinking about where that check really fuels the success of the business and where it drains. So I would say that's one. I also look at a business very differently if they're run on organic versus paid growth. And then I also think there's really something to be said for expanding that share of wallet. I think consumers are so savvy these days, right? We're in this weird stage of growth where people are more skeptical than ever before with parting ways with their money, but they're also more open to new things than ever before. And what I often find is if I can see a business that's got these fundamentals in place where they can grow with new client bases and the same offerings, and then vice versa, I get really excited about where the future can go. And knowing that they've got optionality, this idea of growing in multiple ways, it allows me to feel really safe to give over that capital that they need versus feeling that there's only one way to grow. That's maybe a bit more contrarian than most would like, but I think it's also where I've seen the most success and such permanent, long-lasting success. So, when I think about that benefit of keeping in touch, this is where you can communicate that a lot more easily if you're thoughtful about that first touch, and then you're kind of measuring your own outcomes, your own goals in a way that feels really clear and maybe a little bit more accountable than most of the ecosystem allows for today.
Thank you. I wanted to get you to talk about valuation and just any pointers on valuation, and what kind of raise value you like, you recommend. Sometimes people want to go out with, we're doing a 1.5 million raise, but actually what they should be doing is a 5 million raise. So can you just speak a little bit about valuation? I know it's a complex topic.
Yeah, it is
I'd
with
love to
such a
get you.
diverse group, but I'll say this, I think more about terms and valuation. So that may be helpful. I'm always looking at liquidation preferences. I want to understand, what's available with regards to things like side letters that I mentioned, just because of the unique way that I work with founders and with businesses. But I think what often happens is a too high valuation also feels a little bit off. I think there's something really helpful that I've seen some awesome founders do of recent, which is giving me a base case, then giving me like a medium, if everything goes about right and a little bit better, and then like I'm going to hit it out of the park scenario. I think that that type of evaluating of a business tells me so much more about the business and how it's run than just, what they're raising on, what those simplicity aspects are. And for me, it gets me really excited about looking ahead. So terms for me, super important. Understanding how the money will be used and where that will go and having those kind of three or four different paths. Love that. Um, and I would say a last one is to get good counsel on this. I think what's happened today is there's so many different businesses that are looking for investment. And a lot of the reason is because they're not able to be sustainable on their own. And sometimes that's the right model, and sometimes it's not. And if we're not thoughtful around how we structure our valuation, how we plan to go for growth, I think it leaves the business in a really difficult place. And there's no one left holding the bag except for the founder. So I always say, while it's expensive to invest in legal and strategy up front, I think those are the areas that pay dividends in the future. But it's really hard to see the forest through the trees when you're forking over that check or that, retainer up front. But you will be, I think, better advised with better understanding of what the expectations are for your business in a very personal way. So you notice I don't give a number because it's different for everyone. And if I'm in a seed stage versus a series A, it's going to look different. But I think generally those are the things I see that I'm like, gosh, I wish I had met them, 2 rounds ago as an example. Or where did they get that valuation from? I wonder if I could ask them a little bit more than they've given to anyone else. I think that often leaves a very difficult negotiation when I feel like there's more than I need that's been offered. And every time I ask for it, there's less openness around it. So I always say your data room is your friend. Share it early, but also don't be afraid to take deeper questions than just what you're sent to everyone. I think that just creates that trust gap close a lot faster than anything else.
Thank you for those pointers. So you just mentioned the importance of potentially investing in legal strategy. What else should people be focused on 6 to 12 months before a raise? I know you've touched on a lot of things, but just any last tips would be helpful for our audience.
I'll tell you, as an acquirer, I talked a lot about an investor today, but I think it's overlooked for founders who are raising venture and third-party capital. We do a quality of earnings audit, right? Just understanding like where is the money coming from and how does it look beyond just a quick sheet for projections. I think having just independent analysis can be incredibly helpful. It also will go back to this idea of being advised well on what the valuation be, how much do you need to raise, really understanding where it can go. So I would say that's one for sure, is really getting that third party support to really understand the quality of the earnings you have when you're revenue generating. And then I think really understanding where the money will go in a way that doesn't always come perfectly on a pie chart. I think founders are often the last to eat, so to speak. And when I think about the capital stack, I made a whole growth operating system around helping founders be the first in their, generation, in their lives, in their business to really be the leader that people wish they would be. And part of that is moving themselves up in the capital stack, right? Having different ways of earning is one way to do that. And I think that's also incredibly important is to really think about how you present your business, but also how it's aligned with your long-term goals, your personal goals, your professional goals. And With that 6 to 12 month milestone and time frame, you also have time to take action. I can tell you so many times I'm looking at an old deck. I know I'm looking at an old deck, and the founder is doing the same thing that they said they wouldn't do, a year ago, which is to raise capital but have no clarity on what the money's going towards and what they need. And sometimes that's just a cause for pause. That's just a chance for you to really think about the long term and the short term, because maybe in the short term, there's a burn, there's money that needs to come in quickly, but in the long term, it may not be best for your business. And so when I think about that use of funds, I'm thinking about it so much more three-dimensional than just a slide on your pitch deck. I'm really genuinely trying to understand what the founder needs and how outside capital can really close the gap, but also empower them.
Thank you. Your holistic approach is so unique. I'm really wanting to ask you now about founder mental health. I know that there was a national founder mental health pledge that was started by a VC named Brad Baum. I know you spoke earlier about emotional resilience. Do you have any tips as we, move into Q&A in the next couple minutes to really support our founders on this call around their own mental health? It's such a challenging journey.
It really is. And I think even on the investor side, we all go through it in different ways. It's an area of extreme advocacy for me. I would tell you that the first time I heard about it actually was a founder that I invested in. She bought back her business and invested as the largest non-institutional investor, and really got to know her as a human being and really realized that the reason that she sold and then ultimately felt the FOMO and need to buy it back was burnout, true issues with founder mental health. And she's very passionate about this as an area of her own personal advocacy and has really brought me along on the ride. And what I've noticed is it's really hard to be firing at all cylinders at all times. And yet that's almost what's expected of you as a founder. And so I really thought about this. My kids are just 10 and 11 years old. And so I think about the founders I advise. Sometimes we're similar in age, sometimes there's an age gap, but as part of my own family. And what I'm teaching now more than ever, there's skills that are almost softer, they're less tangible, but so important. And it really comes down to that emotional resilience. It comes down to those leadership skills that a book doesn't seem to hit anymore the way it used to. It comes down to this self-leadership where there's this idea of it's one thing to lead others, it's another thing to lead yourself and to carve out time for your own needs. Honestly, ultimately, it comes down to time management to be able to even have the capacity to think about more than just the bottom line and the next big thing. But I'm seeing more than ever that it's a need. It's something I'm very passionate about, but I don't have a perfect solution today. My best solution has been one-on-one advising. I've done it for over 20 years. I do it affordably. I do it without a contract. I'm a little bit of a renaissance there, but I also believe that part of that one-on-one that I feel that there's still a real need is that there are founders that just won't have the time, won't have the resource. And I've thought a lot about that. And I think at a start, it's having these conversations, but I almost wonder if there's probably an opportunity out there for someone to create almost like circles of conversation around this and permanence around what it looks like to be supported as a founder beyond just when you're raising and when you're exiting, to really find support in that messy middle. It's certainly where I've spent most of my professional life of recent, but I would just love there to be so much more.
Mm. Thank you so much. We are going to turn our attention to the Q&A, and our first question is from Arjun. What is the best way for a founder to stand out and get that first meeting from cold outreach?
Oh, I love cold outreach, actually. I think I'm a weirdo in this whole thing because I actually love being reached out to. I don't need an intro. And I would say the best way to do so is to take the extra time to get to know something about whoever you're pitching. And it may not have to be professional. A lot of times, I'm an adoptive mom. I meet founders all the time that have beautiful stories about foster care and adoption. And it just automatically sets me at a place where I can just be a human for a moment and not just be an investor. So that's one. I would say one other is to get yourselves in the room. And this is hard to say, you guys, because it is very hard to be everywhere for everything. But I think to be really thoughtful would be to tell you that more than ever, conversations are starting in informal environments like a happy hour, and they're closing with investments more than ever for me. And I know many of my investor colleagues. So I always think, what are the two or three things you can do every quarter that can get you in front of the people you like? I can't tell you how many times that I've had that happen where like there was like an informal touch and we just happened to be in an event together. And I think it just gives us an opportunity to connect in a way that feels less pressure, less high stakes. And then from there, move on to something that feels a bit more formal. So don't be afraid to go places where your ideal investor may be, and spend the effort and the time and the money, I know, to be there.
Thank you. And people are obviously asking how they can get in touch with you. So we're putting your LinkedIn in the chat. And um, what are the biggest red flags that would stop you from becoming a board member for a nonprofit or a company?
Mm. I spoke a little bit about the lack of financial transparency. I think that is really something I'm seeing more and more as an area of stuck for me. Um, It's hard because there are things that are formally in, let's say, a data room or a slide deck. And then there's just ongoing ability to understand where the business is at. I think that's probably a really big one. I would say another is not having enough time with the team members that I'm going to be working with long term. You know, the interesting thing about being an investor is that it means you have multiple marriages. It means you have relationships very long term, very collaborative with people in your life that you're not actually married to, but you're in some ways more tied to them than your own spouse. And so you probably are picking up on this by now. It's very holistic and it's also very collaborative and high touch. And I think it should be. And so a lot of my red flags come from people who don't want a high touch investor. For me personally, that just doesn't align with my goals, my mission, my vision, my values. But it also makes me think, what is missing that I'm not seeing that would make someone not want extra support? So I would say those are the two.
It's great. And then I would just be so curious, and I'm sure our founders would be curious to know what areas catching your attention right now as an investor? Where are you focusing?
Yeah,
What
well, I talked about my
what
layers,
sectors?
right?
Yes, your stack.
Interestingly, I'll tell you what it was, and I'll tell you what it's turning into, right? So I
That's
was
great.
a really big advocate in the fitness, beauty, health, wellness, the future of work, and the future of money. And so I've done great things in those industries and felt very comfortable there for a long time. I think what happened along the way, is that there are cycles. And we don't often talk about that, right? So, like with a 20 plus year career, I've had tremendous success in those areas. And there's evolutions in those industries. And so what I think about now is where that ideal client is. And so I think investment philosophy, the whole reason we created the Modern Family Office is around this idea that it's less around a strict industry criteria. It's multidisciplinary on purpose because it makes us great. But it also is around this idea of who is the ideal client and where are they headed next? What are they doing next? And so for me, that means looking at really interesting investments that don't seem to make sense on the outside, and being a lot more flexible about what types of industries that I'm open to. Everything from deep tech to auditing software. I mean, I've really gone the gamut. I've realized there are certain skill sets that are really transferable, and I tend to like to use those. But now more than ever, it's an overlap of industries. It's like, as an example, where is the wellness industry intersecting with tech, where I've had tons of time investing and working in? And so that gives me a whole different view of where we're headed and where I believe the future of our investments should go. And so I'm still thinking that through. I'm still figuring that out. But I would say that's a big part of what I'm doing right now is being much more open than I ever have been so that I'm not turning away investments that I'm going to regret in 10 or 15 years.
Great. So someone asked, I would love her thoughts on the status of fundraising capital for retail companies with a specific differentiator looking to scale. Do you have
Mm.
any intel on that?
Yeah, I actually own one. So I acquired an independent business. It's retail and it's the skincare niche about a year and a half ago now. And we actually purposely did it as a 100% buyout. And there's no shortage of amazing opportunity that comes from that. And I see all the pitfalls. And so retail can be really challenging. I'll tell you what I love about being direct to consumer because I have investments that are across the gamut, B2B, B2C. My favorites are B2B2C, meaning there's a business to business component, and then there's something that goes out to consumer as well. So there's like a layer of different monetization. Lots of great things that have happened, I think, in retail over the last couple decades. Lots of changes ahead. I think if we're being honest with ourselves, we know commercial real estate is in a really delicate place. And so it's even more challenging to look ahead and think there's only one path to success. If you've heard nothing from me so far, I think you've heard a very holistic, collaborative approach to fundraising, but also a multi-layered approach to growth. And so I think having businesses in mind that have more options than just one. So it's not just about getting to 200 units, throughout the United States, but it may be that some are corporately owned, some are franchised, some are global, some are based here in North America. I think there's just less of this rigid view for retail and more around this idea of what makes sense in specific markets for specific consumers at specific times. And that's changing and being disrupted so fast that I feel like the most agile businesses win. I recently heard an amazing best practice from an ice cream company that's realized that GLP-1s are starting to really decrease people's willingness to have that impulse purchase. And what they're doing instead has really impressed me. Maybe enough to get a check. Well, who knows? They're shifting focus. They're expanding their category line in a totally different direction than just ice cream. And the reason for that is they're realizing that things will shift, right? They're brick and mortar stores. They have a food truck component. That has already been a transition in the last decade, and they're looking ahead and going, what would be the next thing that consumer wants, needs, that we can sell them? And I think that is the things that get me really excited about retail is that if you're willing, I think there's a way that we can grow with our consumers. We can grow through that trust gap that I mentioned earlier. We can provide more innovative solutions. And honestly, it will separate the weak from the strong. And I say that with love, but I think businesses in this niche need to be more unique and more excellent than ever before. So it's going to be one of those strongest of the, what is it, the strongest of the fittest, the survival of the fittest. But I actually think that's going to make the entire industry so much better for the future.
Thank you. Our next question, and we had someone in the chat also mention this, is people are curious where you see health and health tech and wellness going with AI.
Yeah, I mean, that's the biggest amount of investments that I've made. And wellness has done extremely well. I was very lucky. I was early to the wellness boom, very, very early 2000s. And so I've seen all the peaks and valleys. I think they're still figuring it out, but I think one thing we know for sure, I've done a lot of data analysis on this in our own companies. And what we found is that the consumer is just so incredibly wellness focused more than ever before. So demand is at a real high, but you have to be incredibly thoughtful about what that demand may be. I've supported everything from independent boutique operators to the largest names in wellness. And what I found is bigger and more scale has been more successful in the more recent years, whereas in the earlier years, we really saw that scrappy independence seen as worthy of a premium. So when I think about wellness, I think we're starting to find there are other ways to bring wellness to the forefront. There are other things that we consider wellness today that we didn't 10 years ago, as an example. And while I won't say it's AI proof, I think AI can make it a lot better. I was an early adapter to artificial intelligence because of my time in tech in the wellness industry. We use AI ML for everything from data analysis and really understanding consumer trends and what was happening inside of the businesses we supported and the consumers that we supported. But we also found that we could anticipate trends a lot faster. We could know what aspects of the niche were going to grow and with certainty, which is why I'm here today. And so I really find that more than ever before, I have such respect for technology. I think there's going to be such a desire and a need for a better balanced life. And that's where health and wellness, I think, will continue to take investment and to thrive. I think technology can make us better. And I think the adequate use of technology and the responsible use of technology is the thing I'm most passionate about, maybe a little bit more bearish about right now, but also very excited about the things that may come and the things that can make this better. And so I think wellness is one of the hottest areas of investment for the future, but I think it will look very different than it did a decade or two ago. So thinking about being more unique, more different than your neighbor, for instance, I think will be the goal in that niche. And with health, the consolidation of our health industries has really been an interesting thing to be a part of. And now more than ever, people want to be well. They want to have good health, and they're going to chase that more than anything. And so I see a lot of investment coming in there. I'll tell you where I'm most hesitant. It's because there are really just a consolidation of players in the health field. And so I'd like to see, legislation open up. I'd like to see some changes so that there's more innovation coming in. And it's not just supporting the massive players at the top, but there's really a mid player and an entry level player that can come in and really change the healthcare industry and make it better finally. So that's my hope.
Oh, well, thank you. I really want to maximize like our last few minutes together. There's a question about people who are building marketplace or platform businesses. What are the most important signals of investor readiness beyond revenue or traction? How can founders prepare strategically before formally raising capital?
Yeah, I actually just invested in one. Let me really think about that because I know it took me a little bit to get to an investment and there was a reason why. And it was exactly this question is I wanted to see permanence. I wanted to see where the business could evolve. Marketplace businesses are inherently really tricky. You have two different consumers. And there's so much that needs to be done to nurture both. So I would say having the ability to show excellence on both sides of the marketplace. Having monetization for both sides of the marketplace would be something else, something I just implemented with the business that invested in. And then maybe as a third, to find ways to connect the dots faster. So for instance, because there's on a marketplace two sides of interest, finding really unique non-overlapping ways to get those two sides to connect. So it may be that there's one way you've been monetizing now, but there's another way that maybe you won't make money at first, but you will get more data, you'll get more interest, you'll get more buy-in, you'll get more acceleration. And I think with marketplaces, a lot of times that's the traction that I'm looking for when I'm looking to invest more than just, how much is being sold, bought, etc. I'm looking at where will this flow as the marketplace will evolve over time. So I hope that's helpful.
Yeah, that is so helpful. I think we'll just end with two key takeaways. One for pre-seed, founders, and then one for later stage founders.
Yeah, my pre-seed and pre-revenue clients and people that I really have such a heart for, I want you to hear me so clearly when I say that it's never too early, but it may sometimes be a good time for you to decide, is it that I need the capital today, or can I hold off a little bit longer? Can I professionalize the business a little bit more so I can actually negotiate the terms I want later on? So that's something from the heart that I would say. For my revenue generating folks, this is where I have such passion for you being more operationally excellent and really thinking about your business. It's not just a job for you as the founder, but as an asset that you run with rigor, with discipline. I almost liken it to an asset manager where you're managing all the different people, the stakeholders, the aspects of the business, the revenue in a way that really feels interconnected and able to grow over time. And so that is an area I'm so passionate about. And I would really recommend that you think about your business that way with the optionality to grow internally and externally.
Well, thank you so much, KK. I'm sure you're seeing in the chat just all the accolades that are coming your way for just a perfect webinar today. Thank you so much for taking time to speak to the community, share your insights, and it was such a great overview. On behalf of the Nasdaq Entrepreneurial Center and everyone in attendance today, we sincerely thank you for joining us.
My pleasure. I'll look forward to next time.
Thank you. We would love for you to all join us for our upcoming webinars. You can view the upcoming events by using the link in the chat. And thank you all so much for joining us today. We look forward to welcoming you back online with us very soon.